Okay, so perfect. We'll start with our presentation. So to start with, again, yeah, welcome all for today's webinar on 401k review and rebalancing. Today, I and my colleague Harshil are going to talk more about the importance of the investment avenues that is there in the US to build, let's say, the retirement corpus for the golden years there. And the main factor we started doing this webinars for the 401k review was for one thing, because let's say there are a lot of let's confusion related to 401k. When you onboard for a 401k, you're not aware about what options to be in and what option to select in and so on, and we just go default with whatever our colleagues or peers are going to be selecting in and investing in a specific scheme, rather than thinking about the risk allocation, your financial goals, and your end let's say wealth creation journey. So to start with, we'll just stick with the basics and give a brief about what is a 401k, how the portfolio is constructed, and what are the investment avenues that you can be in, and like how I thought can be a person or an advisor who can handhold in your 401k investment journey. So to start with, one thing would be it's like we'll start with the fact. One thing is 64% or 63% of the Americans are confused about the 401k retirement plans. So lots of people actually sign up for the employer sponsored program and just contribute in the same. People are not aware about the potential this retirement account have for us. So we'll start with the basics, as I said. So what is a 401k plan? So let's say, for example, if you're a US NRI or an Indian investor who's planning to shift to US, you would be aware of something that we have in India that is called as Employee Provident Fund. So 401k is slightly similar to this, let's say like an employer provident fund in India. But the main thing is you can actually decide the underlying assets where it's going to be invested in. Like for the EPF, major underlying assets, it's going to be into government securities, government debt, and so on. In the 401k plans, you can actually decide based on the employer sponsored program where you can invest, if it is US mutual funds, ETFs, global scale, target dated funds, and so on. So actually a 401k plan or a 401k account is an employer sponsored retirement investment plan. You can take money directly from your paycheck and put it towards for your 401k portfolio, which in turn reduces your taxable income and result in a nice tax deduction that specific year. Since the 401k allows you to save for retirement with tax deductible contribution, which result in paying less taxes today and also having more money to put for your retirement or your golden years. So however, with 401k, you will eventually have to pay taxes during your retirement. That enables employees to make tax deferred contributions from their salaries at the moment. To plan in short, you're just putting the taxations further ahead till the stage of retirement. So one thing would be, it's like to start with, the employee is actually given an option based on the employer sponsored plan, or let's say the broker they're working with, if it is Vanguard, Charles Schwab, and so on, and they would have list of allocations where you can invest in. Let's say if it is a mutual fund, ETFs, or target traded funds. So that would be the allocation in which you will be participating and investing your money towards your retirement or a future financial goal. So a lot of you might have already heard about like 403B plan and 457BP plans are actually both similar. They are yes and no. So they are also a taxed deferred retirement accounts similar to 401k plans. But thing is, 401k plans are open to private employees and so on, whereas 403B plan and 457B plan are open and allowed for only specific, like let's say employees working under public schools, universities, any state governments or local governments, and so on. So end of the day, the workings are similar, but yeah, the name is different. It is 403B and 457BP plan. So what are the main benefits that would come in investing in a 401k plan? So proper tax planning. So one thing is, let's say, for example, you're starting investment journey and there are certain contribution limits per year, right, for you. So based on your income, let's say if you're earning 100 rupees, from that, if you are contributing 20 rupees towards your 401k plan, so that 20 rupees is what you can show as a tax reduction for the specific year. So hence, if you're falling in a higher slab rate, you can optimize this 401k account to reduce the tax liability. Hence, it's a great way of tax planning. And as I said, tax deferred growth. So that there are two types of 401k accounts. That is traditional account and a Roth account or an IRA account and so on. So in that case, it's like, I'll come back to that in a minute. So in this case, what would happen is, let's say, for example, at the moment, you're not paying any taxes, but the end time on the retirement, whatever slab that will be following in, you will be liable for the tax implications. So hence, it would be a tax deferred growth Apart from that, there is something called as employer match. It's a very important feature, and we'll discuss that more in detail in the upcoming slides. So this would be the key agenda for today's presentation. We are going to talk about what are the difference between Roth and a traditional plan, what is all about getting an employer match, maxing out your 401k contribution, more about diversifying the portfolio, and rebalancing and reviewing it on a long-term basis. To start with, what are the types of 401k plans? As I said, there are traditional plans and Roth 401k accounts. So in simple terms, if I'd say is in traditional account, what would happen is the contributions are made with pre-tax amount. So your pre-tax dollars or pre-tax amount from your salary, and it is deducted directly from your income. So this actually reduces your taxable income during the year of contribution. But whenever you're withdrawing it during your retirement and so on, you would be liable for the taxation. Cut to, let's say, for example, Roth 401k. What is the difference here? Here you do the contributions with the post-tax amount or post-tax savings that you have after your salary. So in that case, no tax deductions is applied because already like tax has been paid. Then you are making the contribution for this. But one great advantage of this is during your retirement, whatever compounding, whatever growth you have made in your Roth 401k portfolio, it's completely a tax-free withdrawal. So hence, it's suitable for people who expect during their retirement, they might be falling in a higher slab rate or higher tax bracket. So hence, traditional and Roth 401k accounts are there. It's like in the US for the retirement accounts. And based on that, based on your tax planning and based on your cash flow, we can select and we can see it's like what is the best out of this. So actually, to talk about this is one of the best part of the 401k. Whether it is a regular Roth or a traditional full Roth 401k matching and so on. In certain cases, what happens is, let's say, for example, in Indian context, if you are contributing towards EPF, your employee that you also provide a share, that's 1,800 rupees, let's for example, and your employer is also going to give certain match, right? 1,300 rupees would be contributed from their end. That is in an Indian context. Similarly, certain companies in US have this thing called as getting a match. So in this case, what happens is if you contribute a certain percentage of your entire salary towards your 401k portfolio, the employer would match it with a certain percentage. Let's say, for example, if you're contributing $100, the employer would give you a free match of $60. So in short, it's going to be free money. So let's say, for example, certain companies actually provide 100% full Roth 401k matching. In this case, what would happen is if you're contributing $100, the employer is also going to pitch in and give $100 for your 401k contribution. So people are actually not aware about this getting the match from the employer. You need to go and check with your finance team or HR team, let's say if that facility is available, and you need to make most of this because it's something like a free money that we don't want to miss out, and that's going to help you in compounding and boosting and scaling up your retirement accounts. So every year, the 401k or let's say the IRA accounts and let's say Roth IRA accounts and everything would have a certain limit to contribute on a yearly basis or an annual basis. So yearly, it's like there is the amount or the limit that is set. As of 2024, the limit that is set is you can contribute up to 23,000 as an employee contribution. And let's say, for example, if you're getting a match and so on from your employer, you can go up to $69,000 for this 2024 financial year. And every year, considering the inflation, this contribution limit has also enhanced. Apart from that, if you see, it's like there are catch-up contributions. So let's say, for example, if you're above the age of 50 years, you can contribute more 7,500. Similarly, in the case of employer match, the total contribution that you can do is around about 76,500 if you have crossed the age bracket of 50 years. So one thing is 34% of the small business offer the employers retirement plans, with nearly half of all the US employees working for a small business. But let's say, for example, this is just a 1/3 of the entire basket, right? Let's say, for example, if your employer is not providing you any 401k plan or any retirement option, then what can you do? So this is the query. It's like, what if my company doesn't offer a 401k plans? So it's not mentioned anywhere, or it's not a rule that if you want to save for your retirement, 401k account is only the option. You can consider these alternatives: Roth individual retirement account, traditional individual retirement account, simplified employee pension IRA, health savings account, normal investment account. That is, you can set up just a broker age account there and then start investing based on your conviction, or let's say you can start working with an advisor also. So hence, if your employer is not providing you an 401k offer, you can have this like investment still done for your retirement savings via this all other alternatives. So actually, to talk about more about how your portfolio is constructed, what are the asset classes available, and so on, I would actually pass on to my colleague Harshil, and we'll continue from here.
Thanks, Vinayak. So, so the options that you get in your 401k, they're very simple. It's a bunch of mutual funds, stocks, bonds, and cash reserve. And what we have seen when we have reviewed 401ks plus, uh, we see that there is a lot of diversification when it comes to giving you those options. It's large caps, it's small caps. There are some emerging indexes that you're given an option to invest in. There are some REITs, and then there is some bit of treasury, majorly some short-term treasury that's there for your cash. So majorly you are uh, given these options, but what happens is that there is a lot of crowding in that takes place. Now, Vinayak, you can go to the next slide.
Yeah.
So here you get three options. One is aggressive, one is moderate, one is conservative. So everybody's money. So let's say if you're an aggressive saver in the US, all of your money goes into the same place. Then when it's moderate, it goes into the same place. Conservative, it goes to the same place. So nothing is actually tailor made, right? But it's a brilliant option to basket savers when it comes to their risk appetite, because the options available to each one of them, the contributions that they make based on their risk appetite and their risk profile, is vastly different across all the three. Right. But the only caveat here is that it's not tailor made. Right. And there's something called target maturity funds there, where they auto rebalance. Right. So it does not take into consideration your, how low the market is or high or how high the market is. It doesn't matter. It's more age related. So if you get closer and closer to your particular retirement date, they will just shift it, irrespective of whether you're aggressive, moderate, or conservative. Right. Now you can go to the next step. Right. It's a brilliant option. It's very simple. It's set and forget. It's an amazing option, right? But the only problem is that it's not customized. It's not tailor made. Now we believe that for a saver, there is different needs. There are different objectives, right? So saving for each particular need is very important, right? And that's why we like to take control of the entire 401k and say where we need to park that money, rather than us putting that money across everything. That does not make sense, right? So over diversification is also a problem when it comes to target data. When it comes to all of 401k, you're forced to put some money into small caps. You're forced to choose something or the other, which actually there is no need for you to do. You can just have one bit of concentration into certain sets, and that is what your 401k actually goes out and does. All the money goes into the same place. We'll see how all the money is continuously going into the same place over and over again, and why it is also going in the same place over and over again. Right? So you get a bunch of blue chip growth funds, emerging market funds, index funds. There are STIPs as value funds. So I think we can go to the next one. Right now, this is the most important. 64% of all of our 401k assets are invested in mutual funds, and within that mutual fund, 60% of it goes into equity mutual fund. This is slightly dated; it's about 2-3 years back, but it's very relevant. It's a very relevant study where most of our money goes into the equity part, and within that equity part, it just goes into the top 10, top 15. Right, when max 7 plays a huge role in it. So top 10 is where actually most of the money goes, and then there are some hybrids to cover up for that concentration risk, just to balance things out, and then there are bond funds and there are money market funds. Right, next one. There is a question. We will take questions at the end of it, but yes, 401k plans, if you see equity, target dated, and equity. So this is what the average allocation actually looks like: 40-45% in equity. Yeah, in equity funds, and then there is some target dated funds. So most of it in the target dated funds also, it's more or less the same thing that's happening, right? But it's auto rebalance, which is a very good thing. Auto rebalance is a very good thing. Just that the timing is not under your control. Timing needs to be definitely under your control. Right. Next slide, please. Right. Now, the problem with crowding is that it raises the question of valuation always, right? So if you see now, we are very close to the dot-com bubble, and most of it is driven by the top 7, 8 companies. You see Nvidia hitting through the roof. You see Apple now suddenly hitting through the roof. You saw Netflix suddenly have their earnings come in, which was very strong. Yes, there are some growth risks going forward, but yes, earnings had come in very strong. So you saw 11%, 12% out of jump in just a day, right? So anytime there is some bit of crowding in, anytime you see that a lot of people are going to the same place over and over again, it raises that risk of valuation, and then you have a de-rating that takes place for years, right? You saw that the last peak, the people who put money in the last peak for Microsoft did not make any money up until 2030, right? So it's a long journey, it's a long wait, right? Whenever you take that risk of valuation, right? Next slide. Now, this is a very important, all of these are proofs, right? That yes, money is going to the same place over and over again, and you are running that risk of valuation. So you need a good amount of diversification. Now, you go to your 401k and look at your 401k, there will not be one single allocation that goes into precious metals, right? You will have about 6-7% that goes into REITs, but you will not have one single allocation that goes into precious metals. And wherever we have taken over 401k allocations, we have made sure that there's enough precious metals in the portfolio, there's enough of commodities in that portfolio, because this is a completely undervalued part of the entire market. Plus, it's not looked at, right? Though it makes a lot of sense with the risks that are present in the current geopolitical landscape, you definitely need to shift your allocation towards parts of the market that are not being paid attention to, right? Where the things are extremely cheap, right? So if you see this, the dominance of the top 7 as a percentage of the market cap of S&P 500 is at its all-time peak. It's about 34%. 34% of the entire S&P 500 market cap comes from just 7 companies. Just 7 companies. So the other 493 are completely irrelevant. And why they are irrelevant is because the earnings growth has not been very strong, no matter what they project. Right? If you can go to the next slide. Right. So if you see here, there has been a lag in terms of the performance, right? If you see, momentum continues to be something that is being chased by active fund managers, right? So they are continuously overweight by about 30% versus the S&P 500, right? So that in spite of the chasing that continuously keeps taking place, or in fact, in addition to the chasing that takes place, this is what is adding up to more and more of the crowding in that takes place into just those 7-8 companies, because they are only continuously delivering. So you can't, it's very difficult for active fund managers to go out and beat the benchmark. So yes, they follow more tilt towards momentum based strategies, right? And this you continuously keep seeing over the years. As and when it hits a peak, it comes off, and now again it's at a peak, right? So most of the pension money, even in the UK, most of the money that's being managed even there, has a tilt towards momentum, and they are somewhat far behind in terms of catching up to performance. Right. So if you look at how many of these active funds are actually going out and outperforming their benchmark, 47% of the funds actually went up less than half. So don't be shocked. Even in India, there are parts of the market where you don't go and beat the benchmark. But this was a fact in 2022, where 2023, where small and mid caps, active small and mid cap funds did go out and outperform the benchmarks, and now it's reversed. It's not happening that much, right? Large caps have been laggards, and now you're seeing this is a trend that's been there across the world, where active funds, the percentage of active funds that is outperforming the benchmarks are very low. And if you see now, again, it's at the same similar low as what it was in 16, 19, 22, and again in 24. Right? So not a lot of funds out there, in spite of chasing momentum, in spite of being on the parts that are performing very well, still don't go and outperform their benchmark. Vinayak, I think you can come and take over.
Thank you, Harshil, for a brief intro about what's happening right now in the market and how the construction of the portfolio works in. So let's say, for example, this is a query we generally get for the 401k reviews. Like, what do we do when we retire early or make a shift in a job profile? So actually, like job hopping is common nowadays, like considering all the tech and other sectors and everything. So instead of like directly moving out your old 401k or withdrawing directly, it's actually recommended to roll over to a new IRA account where you don't have any limit of, let's say, a company sponsored plan and so on. Or let's say if you want to shift it to a new job, then it's much ideal to shift it to a new 401k account. Because why we would recommend this? Because let's say, for example, if you're leaving a job, then whatever 401k corpus that you have built there, when you're shifting to a new employer, not rolling it over to a new employer, whatever contributions you have done, you won't be able to compound your money there. You would be just able to review and rebalance it over a period of time. Only the new plan you will be able to again contribute and compound your wealth and create a corpus. So hence, it's very important to let's say roll over your accounts whenever you are shifting a job or let's say starting or let's say doing an early retirement scenario. And apart from that, rollover is very crucial and needs to be done correctly to avoid any unwanted tax consequences, because that is one thing that we want to avoid. So what the data shows is also it's like lot of withdrawals are also coming in all the 401k accounts. Uh, 2015 and backwards, it's like it was less than 1%, and it has grown to 3.6, and 2024 the data whatever has come in is almost in the range of 3.8 to 4%. So in this case, like people are actually going and are directly withdrawing from the retirement money, and that not actually a very ideal scenario, because one thing, there is a tax implication. Apart from that, there is a heavy penalty that you have to pay. So what we recommend all our clients who are investing or doing a 401k review is we need to build a separate kitty or an emergency reserve or a contingency reserve, so that even if there's any like unexpected withdrawal or so on, we can actually tap into that emergency reserve rather than withdrawing or disturbing the retirement accounts. So this is a very interesting example. Let's say, for example, whatever portfolio we have built of, let's say, $60,000 and so on, and one hardship withdrawal of $10,000, it's like what is the amount that you would be getting is 1,000, that is 10% would go directly for the penalty and charges. 20% possibly would be a tax liability. If you're on a higher slab rate, it will be much higher. So hence, you would be just left with $7,000 and so on. So hence, it's much important to have a separate contingency reserve and emergency reserve for anyone who is starting fresh or who has not built a separate reserve so far. So apart from that, it's like before selecting any instrument, it's very important to review your risk tolerance and risk capacity. And it can be easily done over a lot of, let's say, in website, or let's say in Google itself, there are a lot of questionnaires available. With 10 to 15 questions itself, by answering, you will get a risk report where you can see it's like what is your risk-taking capacity based on a specific risk score. So it's like, yeah, staying on top of your 401k company match. Just as a follow-up on what we had discussed earlier about getting an employer match, we need to know about what are the company rules for the contributions and getting a right match. We need to speak to our HR and let's say the finance team to learn more about the employer-sponsored plan and figure out if there are any vesting schedules aligned to the same for getting a match. So more about I thought it's like Harshil, it would be great if you can give a quick run through on what we are doing in this global space and how we can actually help the clients in reviewing the portfolios and guiding them. Yeah.
Sorry, I just was having an internet problem. Yeah. So see, we started ithought back in 2013. And we were very clear that we do not want to go the stock route immediately. So we were sticking to mutual funds. And why mutual funds was because that at that point, this rule came up for direct mutual funds. So we said, yes, this is a very good option for us to do from an advisory point of view. So we started giving out advice on what we were practicing, before we started the service, which used to be more concentrated, which used to be more value oriented, and over a period of time that model got a lot more better, where we were very conservative in what we want to choose to invest in, which means that valuation was a very big metric for us, but we were very aggressive in how much we wanted to deploy into that particular business. So we used to take a lot of concentration risk, high conviction bets, and that used to work out very well. We saw 2-3 years where the idea does. So we are majorly a buy and hold. It takes us some bit of time to scale up to our desired allocation, and then see that money play out. So we did that in India in public sector. We did in infrastructure funds. We saw it happen in commodity related funds. We saw it happen in pharma funds. And now we have shifted most of our allocation towards financial services. So over that time, as we saw success in that particular model, we started putting it across direct stocks as well, which is when the PMS came in. And there were some regulation changes that took place in the advisory space. So we shut that business. That business was about 400 odd crores when we shut that business. And we were concentrating only on the regular plan side, which is mutual fund side, the MFD part. Right? And Vinayak comes under the ithought plan, which is more on the planning side, where we give advice on your entire wealth. Right? We take a holistic approach and we advise on your entire wealth, give you clear direction, have quarterly reviews to make sure that we are on that path to reach your particular goal. So that is ithought in a nutshell. Vinay, can go to the next slide.
Yeah.
Yeah, so the philosophy is very simple, bottom up, non-consensus, which is what contrarian means, and it's buy and hold, so it will be long term. High focus on risk management is what I was talking to you about, how we are conservative in what we want to buy. They will majorly be monopoly oriented companies. They'll be top three or something in that particular industry. It will be a niche industry, and it takes us some bit of time, 1.5 years. It can take 1.5 years for us to build a desired position in that particular business, and for that business to play out will take about 3 years or so. Right, so that's what we do from a philosophy standpoint. So I think now we'll open the floor for Q&A. So this is the same philosophy that we are bringing to global investments. So we have a product called Sphere in which we are investing on the global side, which is via ETFs, via mutual funds. And that part is, so on the RIS space is what we used to practice global investing, which again used to be more on the ETF side, on the mutual fund side. And that along with the PMS, like how we went from mutual funds and ETFs to direct stocks, we are doing that also on the 401. Right? So it's the same level of research that went into the Indian market, now onto the global markets. Vinayak, I think there was a question that said, does it mean irrespective of the broker account I choose, whether it is Fidelity, Merrill, will the allocation or distribution of 401k be the same? See, more or less it will be similar, right? You will still have the vanguards. You will still have a couple of funds from Fidelity itself that you will have to do. And not that they are bad funds. There's some funds that are under our recommendation list from Fidelity as well. They are of very good quality. Right? They are of very, very good quality. So more or less, you will have the same allocation, right? There will still be an emphasis of overweight on the large cap side. There will be some allocation that goes towards emerging. I'm just saying from a broad perspective, you will have majorly large caps, then you will have some emerging, then you will have some tips, you will have some on the small cap side. You will not have a mid cap. We of all the reviews that we have done, we've not seen a mid cap coming in yet. Right? Though there are options available to you, Artisan does a good job, but if I'm getting the name right, but we've not seen it anywhere when we're reviewing. But more or less, it will be very similar. The question was, can I roll to IRA and start investing on this IRA if my no? Yes, I think you've answered it. Yes, you can. Okay. What are the solution offerings from ithought, how is US Indian taxation factored, PFIC rules with respect to investing in PMSMS via ithought, how do I report any investments I do via ithought as part of my US tax filing. Vinayak, you want to take this?
So in this case, what would happen is, let's say, for example, we do have PMSs where the underlying assets are purely, let's say, stocks or securities and so on. And apart from that, let's say mutual funds and ETFs would be the investment vehicle that would actually come under the PFSC implications. So let's say, for example, we have the Neo portfolio where we don't invest across any mutual funds in India and so on. And in the similar case, let's say, for example, even if there is any ETF implications or it falls under the PFIC, we will provide you with all the capital gains, let's say, reports that are necessary. And let's say if you already have a CPA, you can just redirect it to them. And that can be more on an easier level. Because what happens under PFIC would be in mutual funds and ETFs, generally the notional gains are taxed, whereas in mutual funds, the gains would be on higher end. But whereas in the ETFs, it's like, again, it would be on a lower factor. So hence, it's like this is something that we can provide you with the reports. It just, as of now, we are not providing any help with the tax filing part. But let's say, for example, in future, if we work it out that, hopefully we can do the same for you.
I think the next one also is something that you can take is IRA
also self-management, as in the passive distribution of funds across various instruments. So what happens under 401k is when you work with an employer, they would have a specific tie-up with a broker. Let's say, for example, Vanguard. They will be providing you a list of options under the Vanguard of, let's say, any other distributor or broker. From that, we need to sit and select and start our investments. But if it is an IRA, the universe is vast. It's like based on your, let's say, conviction and your requirement, you can keep and have the allocation. So in IRA, you don't have a restriction on any investments. You can spread it across like globe based on your conviction. Whereas in 401k employer-sponsored plans, it would be limited universe based on the employer type with a specific broker. Also regarding the PFIC implications, we are also preparing a brief report, or let's say, and we are gonna like put it out as soon as possible by early next week, and so on a YouTube channel and let's say a blog post. So it's like we'll be redirecting it to all our US investors and let's say prospective investors like on the PFIC implications. So you are also very well aware before committing for any investments.
So where can I get specific details about various offerings? Also, what's the minimum investment? You mentioned overall investment review. How is that done? So if you choose the PMS, the minimum investment is 50 lakhs. We have 4 PMS products. One is the multi-asset one for non-resident Indians, which is Neo. There is a flexi-cap fund called Solitaire. There is a large cap fund called True Blue. And there is a small and mid cap called Vriddhi, right? So Vinayak, probably after this call, or if you have those details ready with you can just project it now. But minimum investment is 50 lakhs. And the fees that we charge on 2 of the products is 1.5% per annum. If you add GST and other costs, it would be somewhere between 1.75. It's a per annum cost that will be charged to you quarterly. So you don't have to take out anything from your pocket to give it to us. It will come out straight away from the portfolio. And our dividend yields across both those products are somewhere between 1.3 to 1.35%. So it covers up for most of the fees that is there. Everything else, all the growth is yours. There's no profit sharing in these 2 particular products, right? And Neo does not even have an exit load. Solitaire, which is the flexi cap one, has an exit load, right? This is on the PMS, right? And the fees will be charged to you on the net asset value. So 50 becomes 75. Let's say, for example, 50 becomes 75. On the 75 is what you will be charged. We will take over the entire execution. The discretionary PMS comes under SEBI. We will take care of the entire execution. You will just keep getting monthly reports from our side. If you have to have a one-on-one call, we can have a one-on-one call to discuss things that we're doing as well. Second, there is a lot of content that we're posting outside. There are webinars that we're doing very similar to that of the 401k. You will have free access to everything. This is if you want to invest in India. And the 401k, Vinayak, if you just want to take a brief on how we are charging on the 401k reviews.
So actually, it's like we have not set a specific, let's say, a fixed percentage and so on. It's going to again depend upon the scope of work that would go in. Let's say, for example, if you are retired, you just want us to review your portfolio and rebalance it on a half-yearly basis or yearly basis. The cost structure would again depend upon the portfolio and so on. Let's say it's like you can still do some contribution on your portfolio, but let's say your universe in your employee-sponsored program is very limited, and you need help in setting up a separate brokerage account. Then having a separate like recommendation there, again the scope of work would change. So hence the fee would depend on various factors, and it's we can actually connect over a call and discuss on the same.
Vinayak, you want to take this? What's your take on Indian citizens returning to India, and would you recommend leaving the 401k in the US? Is this why offering helps us to review periodically and adjust? Have you done detailed analysis and present data points? Also, what are the tax implications for India and US after it being withdrawn after 15.5 years?
So in this case, what would happen is, let's say, for example, if you're living in the leaving the US, and if you're like, let's say, across the 59 years of age and so on, so whatever pension amount that you're going to get, or let's say whatever withdrawal that you would, we can actually have it as an exempt way in the taxation wise in India case. It's going to be, let's say, already taxed in the US, and we can show it as already the tax has been paid off in the global space. And here with a double tax avoidance agreement, we can like avoid the double taxation on the whatever gains that you get after your retirement. And apart from that, let's say, for example, you say it's like what to do while leaving 401k in US would be, let's say, when if you are living at the age of 45 or 50 and you still have 9 years to go, at that time also I would actually recommend based on, let's say, if the requirement is not there of that entire cash component and so on, you can just let it compound. It can be a huge chunk of global allocation that would be there in entire net worth, and still it's like we can build up on the Indian side also and other equity components and asset classes. So hence withdrawing it before the retirement age is not that recommended, because there is the penalty of 10% flat. There is an tax implication there. Apart from that, if you're withdrawing it before your retirement age of 59 years and so, in Indian context also, you have to pay a certain set of fees and charges. So in this case, considering all the conversion and everything, it's very ideal to let it be there until the age of 59, and post that, unless there's any requirement, and post that we can withdraw it in chunks and so on based on the requirement. Also, it's like, is that where you're offering to help to review it periodically and just, yes, for let's say, for example, if a person is already retired and they have a portfolio, let's say they have settled back in India, we are doing it for most of our clients where we are reviewing their portfolio and rebalancing it. Let's say, for example, we won't be able to do much of the action in, let's say, allocating new capital, but with existing capital, we will have it in a very conservative way, and we can have the necessary allocation in gold, global equities, and let's say debt component and so on. So hence, that is something we can do. And we also do detailed analysis. It's like in last 6 months we have done more than 600 plus fact sheet review of all the brokerage there in the US, and then we have actually shortlist, and we are tracking a certain let's say stocks, ETFs, and mutual fund portfolio, from where which based on your risk capacity we are going to recommend it to you, and hence that's going to be a detailed analysis that we present to our 401k investor and so on.
So you will get a proper presentation done from our side. It will be done over call. It will be a 45-minute, 1 hour call. We will tell you that these are the options that we looked at. These are the options that are there with you. These are the options within that is what we recommend that you should be doing, and it's up to you. If you want to go out, execution is not on us. Execution will be completely on you. And let's say, for example, if there is another call that comes saying, yes, we want to buy this, yes, we want to sell this, Vinayak will get in touch with you immediately to tell you that yes, this is something that you need to go out and execute, and the execution part only remains uh, on you. So we are taking over that level of execution risk because it's not in our hands; it's on your hands. But to go out and execute whatever advice that we have given.
So also one query is I am already working with the advisor to invest through M2W program. For 401k review, they can help as well, or we need to reach out to. Actually, so you can just drop a text to them saying like you are interested in the 401k review service, and we will internally connect with them and we'll surely get in touch with you.
In fact, you can just put your number in right now, and Vinayak will get in touch with you immediately. In fact, to add to the point of the number of fact sheets that we have seen, it's not alone in the US. We had a request for UK pensions as well. So we started that work for UK pensions, and that level of work actually helped us a lot because it gave us a lot of insight about what people are doing, how people are managing money in the US, because some money definitely gets allocated towards the US part. Right. So we got to know how fund managers are actually dealing with their allocation, and that made us to go one step deeper to see, okay, they are now, it looks like yes, definitely there's a momentum that they're following. Are they beating that particular benchmark? Right? How do you go out and start beating that benchmark? Because then only behavior starts coming in, and that level of scale up, how much is the concentration risk in that one particular idea that is actually giving them that outperformance, that actually gives an investor an outperformance, is what we started to study. So that's how we got these data from. I think we'll keep the floor open for a couple of more minutes. We'll keep the floor open for another 3-4 minutes. So any questions, any doubt, anything, please shoot. We are very happy to, in fact, extend also if something goes up. So there's a comment. I don't have a retirement plan in the US, but my organization does match to an extent. So I utilize the 401k channel. Will it still be advisable to invest in the 401k considering I will repatriate the investment at some point of time or may not be after 60 years, which is a good approach.
So again, that would again depend on different case and scenarios. So let's say, for example, if you're already falling under a higher slab rate and tax bracket, that extent would be is what whatever proceeds you're withdrawing would be taxed before the age of 60. Additionally, there would be this 10% penalty. So in that case, let's say, for example, you can create actually a separate IRA account where you can start investing in. And there also, so one thing would be, let's say, for example, still you don't have that conviction, okay, you are going to stay there for that long term and so on. You can have that component as a minimum thing that would help you in your tax planning and reduce your tax liability for now. And then, let's say, for example, in the other hand, you can just set up a brokerage account where you can actually invest across globe and US markets and so on. So that is would be very ideal for you, sir.
So I think what we can do is Vinayak will get in touch with you after the webinar. I think when you registered itself, you would have given us the email ID. So we'll get in touch with you in the registered email ID. And then he can set up a one-on-one session with you and show you some samples of how we have done that analysis, what we can actually do for you, right? And what your requirement is, and whatever requirement be, depending on the scope of work, then we can move forward with the agreement. Thank you so much all for your time. I think if there's no more question, then we'll close. We'll keep the floor, 2 minutes more. I think I see somebody typing.
Yeah. Thank you, sir. Thank you for joining in for today's webinar.
Yes, we can connect via email. With your registered email for the webinar, we'll get in touch with you.
Yeah.
Vinayak, you just put in your email ID so that it's easier as well. So it's Vinayak at ithought.co.in. So you can use this ID to connect as soon as possible. He'll also connect with you guys once he gets the registered email IDs from the communication team. Right? Done. Thank you so much all. Have a great weekend ahead. Thank you.
Yeah. Thank you.
Thanks, Vinayak. Thank you.
Thank you, Harshil. You too.